I invite you to present your paper.
Yeah, let me share my screen first.
Thank you.
So does it work? Hello? Hello, can you hear me?
Yeah.
Okay. And the screen's working.
Yes, it is. Everything's clear.
Yeah, thank you so much for inviting me to the conference and allowing me to present the paper virtually. I does have some visa issues to prevent me come outside. So I'm going to present a paper on the government investments and private investments in venture capital in the context of China. Government around the globe has initiated various venture capital programs. For example, Israel has the Izuma Group, which is a government-related venture capital funds, and we have some examples in US, Canada, and various European and Asian countries. The key question to understand whether those government programs will be effective or not depends on how private investors respond. On the one hand, government investments may increase the total amount of investments if the private investors respond positively. Or from the very classic econ theory, we also know that private investors may be substituted or crowded out by government investors. So it is an empirical question to see how the private investors react to more government investments. And to give you a bit feeling of where the literature stands. So if we look at the credit market, the loan market, there is a mixed evidence. So on the one hand, we do have some crowding out effect. For example, either in China, we have, for example, the Rule 2018 Straight paper, or around the globe in large corporations, we have consistent crowding out phenomenon. On the other hand, the recent literature tried to go back to the theories to see that if in an environment with high information asymmetries, do we have crowding or crowding out effect? Because in an environment, in a market with high information asymmetries, the original investment without government investments can be in an inefficient level. And with some government intervention, it may actually restore the total investments to a more efficient level. So for the empirics, we have a recent JFE paper where people shows that in small business loan market, actually we have the crowding in effect. So in this sense, it will be interesting to study this question in another environment where we have high information asymmetry and riskiness, which is the venture capital market. The venture capital market is very different from the credit market. The underlying companies' riskiness and the information asymmetries between the investors and the companies and agency conflicts. But it is also of great importance in terms of creating innovation and support for growth and employment. So in this paper, I asked this crowding or crowding out question in the context of venture capital. That is to say, I'd like to know whether more government investments causally lead to more private investments in venture capital. The main findings of the paper is the following. I do find that crowding is in fact dominant, which is consistent with the small business loan market, and the effect is more significant in less developed regions. And this provides the reason why I use China as a setting, because in the large country, we have developed, less developed regions under the same institutional environment. Speaking to the mechanism behind, I find a diminishing networking pattern, which is consistent with there's some soft information transmitting through the networks among investors. In the sake of the time, I will skip the literature slide. Basically, says that there are mixed evidence for a bigger question on government intervention in entrepreneurship or innovation. We have some positive and some negative evidence. All right, so what is the contribution of my paper? So this is a paper. First contribution lies in that I established a causal relationship using real-world data. So when we started this crowding and crowding out question, there is a very important endogeneity challenging because government investments and private investments can depend on some confounding factors such as the local economic conditions. To address this endogeneity challenge, I exploit a policy experiment in China, which is staggered introduced in different regions at a central level. So there is a central government program, which itself is very small scale, but it is introduced in different provinces at a different time, and it provides some shocks to local governments. And then I could see how the private investors also respond to the local government response. And I also provide a new way to understand how the government investments may have a transmission role to private investors by taking the advantage of the new data in China, where we could observe all the investors in the same fund, and I could build up a network using the investors. All right, so let me briefly clarify what is government investment in venture capital, because the venture capital sector itself is a bit complicated. So in the venture capital sector, there are multiple players. The first is the venture capital firm, a VC firm, and this firm can manage some funds where there are limited partners, investors who put their money into the funds. So in this paper, I focus on whether the money is from government or private. That is to say, the first step is to classify the limited partners, the investors, into private limited partners and government limited partners, which based on whether they are a government institution or fully controlled by a government institution. So the money is essentially the government money. And then based on this classification of the investors, I divided the funds into government funds and private funds. A government fund means there is at least one government investors. And in a similar way, I also classify the VC firms who are managing the funds into government VCs and private VCs. So that is to say, the VC firm that is managing a government fund, it is a government VC firm, and the rest are the private ones. So in this way, the government intervention mainly comes from the LP investments into the funds. This is a very clear classification, and also it is very relevant if we consider what happening in reality. So like for the pan-European programs or the programs in Germany, Korea, and China, the main way of the government intervention is actually the government is putting some money into some funds. So then about the measurement of the crowding effect, you might think in this way there might be some mechanism, some mechanical crowding effects, because maybe the government directly asks the private investors to co-invest together with them to put some of the money together with the fund, with government investors in the fund. This is what happens in reality. However, to make the paper more interesting, I'm not measuring that potentially more mechanical effect. What I'm measuring here in the paper is if we see some government funds, how many purely private funds without any government money are also established in the same region. And similarly, I look at how many future investments are made by purely private investors. All right, So a bit of the background of the venture capital in China. The China is becoming the second largest VC market, just next to the US, and it has a large trunk of government investments. So in the policy experiment I mark it as a national program, which the first year is 2008. And we could see clearly after the initiation of this central government national program, the investments both from the government and the non-government limited partners increased largely. All right. So in the paper, I use the data, the time for China, and the time period is from 1990 to 2013. I mainly look at the fundraising part in the paper. So for the fund information, I combine the Zero to IPO, which is a commercial database for venture capital and private equity, and also the official Asset Management Association list, where they provide the official list of all funds. About 1/4 of the funds has some government investments. And then to pin down the limited partners into those funds, the investors of the funds, I combine the information of the government administration data. To be more specifically, it's called National Enterprise Credit Information Publicity System in China. This is a very interesting government administration data source where we could observe all equity shareholders of any legally registered entity in China. So this provides a way to pin down the investors into the funds. And then for the central government program I'm looking at is called InnoFund VC program. I got the detailed information directly from the Ministry of Science and Technology in China. And finally, for other controls, I just use the standard Sysmine Win database.
Celine, you have 3 minutes.
Okay, so the main findings of the paper answers the question whether government programs lead to more VC activities. So I use the central government program as a called the experiment, and why this is a great experiment, why this is a randomized experiment. So first, in the policy document, it is stated that at least in the first 2 years, there are some regional experiments by choosing some trial sports. And second, I do check the correlation between the timing of the program and the observed characteristics like the VC activities, innovation, atmosphere, special industry zones, or economic, mainly GDP. And the coefficient is insignificant in most cases, which means the timing of the program is not correlated with all these observed characteristics. And we could see from the map that it looks like it's spreading a bit randomly across the years. And I also checked the parallel trend assumption to see if there are any unobserved characteristics that is related to the timing of the program. And we do see the difference between the treatment and control group is insignificant before the program, but it becomes positive and significant from zero after the introduction of the central government program in that region. And it's true for both government side and private side. Because both the government and private local governments and local private investors respond positively, this implies that the crowding-in effect dominates. So in the paper, I conduct various robustness checks. The coefficient varies a bit, but it's within the reasonable range. So in summary, at the regional level, we observe that crowding-in effect dominates the crowding-out effect. And one very interesting part of the result I like most is we do have heterogeneous impact in different regions. So if we look at the poor region, we see that before the program, there is almost no difference, but there is a big jump of the program for the treatment group. And if we look at the middle region, actually, we observe some mixed evidence. And for the most developed regions, while there is still like increase for the treatment group, the increase is almost parallel for the treatment and control groups. So in this sense, what the strongest effect is actually in the less developed regions. So let me briefly go through this investor level evidence. I also conduct investor level analysis where I define the network distance between a private and government investors based on whether they co-invest together before in the same fund. This is current worm. And if I, as a private investor, I invest together with someone who invest together with government investors before, then it's government 2 and similarly as government 3. I stop at 3 because in the data, there's not too much investors connecting beyond 3 layers. And we could see that first, there is still a positive effect, means that the private investors do make more investments later on if they made some investments before together with governments. And I should emphasize it's more interesting to see that this pattern is decreasing in the network distance because it becomes smaller with more layers.
Celine, we are out of time. Maybe you can wrap up in 30 seconds or so.
Yeah, all right. So let me conclude. So the main finding of the paper is that the government investments can crowd in private investments, at least in my setting and my sample. And this is most significant in less developed regions. I try to show this is a causal relationship by exploiting a policy experiment in China. And I also underscore the role of the connections in network effects among investors in explaining this amplification effect of the government investments. All right, so I'm down here. Thank you very much. And I'm looking forward for the discussion and questions. Sorry, I think I cannot hear you.
We haven't started yet.
Okay.
Just getting my slides up.
Okay, thank you.
Oh, perfect. Thanks. Thanks to the organizers for asking me to discuss this paper. I don't know that much about venture capital. I do know a little bit. I don't know that much about China, but I do know a little bit. So I guess the combination sort of works. Of course, I'm Rick Sen from University of New South Wales. Let me see if, sorry. Is the clicker working? Sorry, just working out the clicker. Let me, sorry. The clicker is not working. Maybe I can do it here. All right. Maybe now it will work. Yeah, perfect. Okay, so let me quickly first explain why I like this paper. Firstly, maybe Celine didn't explain enough. She actually combines a bunch of novel data sets and puts together something that's not easy to do. So she has a comprehensive set of VC funds And then in those funds, she can identify all the limited partners for those funds, which usually is not that easy to do in many other countries and contexts in the literature. And then, of course, she knows the general partner and the firm, VC firm behind the general partner for every fund. She also sees a comprehensive set of deals and who are the deal participants for all the deals. Now, using this, then she's able to ask an interesting question, which is, can government investment in venture capital actually crowd in, which is get even more private investment rather than crowd out, which is reduce private investment in the venture capital context, right? And essentially, she finds that's the case. It's interesting because the crowding out versus crowding in literature in the China context has mostly been in the credit context, and the evidence overwhelmingly seems to be in the favor of crowding out. When the government gets in and tries to give credit or tries to raise credit or does anything of that sort, it basically crowds out the private, non-state-owned enterprises. They are actually worse off. So there are multiple papers that show that. Now, in the VC context, obviously, this is an interesting setting. China is a nascent VC market, and how can a country grow such a market is presumably of interest to a lot of other emerging markets as well. And I find a number of patterns, empirical patterns documented very, very interesting. Right. Now, I will not dwell on this too much, but let me explain just the terminologies. So essentially, at the center, we have this VC fund, and the VC fund is what invests in portfolio companies to whom it gives money and advice. The fund is managed by a fund management company, and this is called the general partner, or GP. And then there are lots of investors who only give money, but they don't get involved in a day-to-day operation. They are called limited partners. So these, in Western countries, can be institutional investors and so on and so forth. In China, that is presumably not the case. There could be individual investors and also companies, which in China is the case. So the limited partners just put in their money. They are LPs. GP is the one who's managing the fund. Okay. Most of you probably knew this, but because I'm going to use this terminology. So what happens in this paper is what they find is government program is to invest in VC funds in different ways. They set up GPs as well as LPs. They go and invest in funds. Of course, when the government is setting up VC funds and it's creating new funds, you expect there to be more funds, and you expect there to be more investments from the VCs. What is interesting, however, is it also increased purely private investments, meaning there are new funds being set up in areas where the government starts to set up funds which do not have any government-affiliated GP or LP. Okay? That is the interesting part. And also, if you look at the companies or these small innovative companies who are getting funding, you see more of these companies getting funding from purely private funds who have no LPs or no GPs from the government. So that is what Celine is calling crowding in. Of course, this is also true for the government-owned funds. They are funding more companies and so on and so forth. But there's this additional effect that other people are doing more of the same, what the government is doing. That is the interesting part. Now, the effect is more pronounced in less developed regions, which is nice from a policy perspective. Then she has a bunch of other results, which is funds with government limited partners tend to attract more private limited partners in the same fund. Okay? Also more first-time private limited partners in the same fund. Presumably, it's fostering the VC environment. At least that's the interpretation. More limited partners are coming up among the private limited partners, and they are then going ahead and investing in young startups and so on, right? And she has a bunch of other things. I don't want to get into that. So my first comment is just trying to think about the impact. So I'm not going to, at least in the, right now, quibble about the empirical strategy and so on and so forth, but let's take big picture, what should we take away from this, right? So the basic thing that she finds is the number of funds go up for government funds, and number of funds go up even for private funds. And then the number of deals, which is the companies which are being invested in, they go up which is deals, which is companies that get funding from government funds go up, and companies that are getting funding from purely private VCs, they also go up, right? So one thing to be noted is there is some effect in year zero. The year zero is where the vertical dashed line is. So you can see that is a little bit above year -1. And then there is more effects in year 2, 3, and 4, year 1, 2, and 3, and they are kind of at the same level. So there's sort of a persistent effect. Now, of course, there is more funding. The natural question is this good or is this bad? I mean, you could fund bad companies and kind of waste money. So that is the next natural question one would want to know, right? So in the paper, the only quality metric that one can find, and of course, this is the disadvantage of the data, but there is one, which is the exits through IPOs. Did the invested firm exit through an IPO? And when I looked at this picture, there are a couple of puzzling patterns. So in year 1, you see the number of IPOs increased, right? Firms that were invested through government VCs, they are more likely to exit to IPOs, but actually it goes down in years 2 and 3. The same thing is seen for private VCs. My first thought was, okay, at least IPOs is going up. There's some evidence on average. But after 1 year, isn't that too soon? And the second is, okay, why is it becoming negative in years 2 and 3? Of course, on average, it's still positive, but the trend seems to be this. So if you're interested in the big picture question as to whether this is good or bad, we want to sort of understand this a little bit better. So here are my thoughts, and this is not there in the paper. So my explanation is, based on this Ernst & Young 2014 report on VC in China, says China is actually a little bit different. VC companies in China are typically more developed. And VCs invest further along in their life cycle, and they are looking to exit within 18 to 24 months. In contrast, the median time for a VC exit in the US is 7 years. So we are actually talking about something quite different in the context of China, and now it kind of makes sense. Fine, I can expect to therefore see IPO exits within a year or a year and a half in the China context. But it would make no sense to me in the US context. I think Celine could help highlight this as to why one might see this. But this also implies that the way we normally think about VCs is not true for China. They are not funding early stage, very young, innovative startups who don't have access to other kind of capital. They are funding much later stage companies. Okay? So the whole, my suggestion is this should be clarified to the readers, and therefore we have to see the results through this lens. Now, the potential explanation for the second pattern, and this is why is it going down after the first year? This is pure speculation, but I think her data will allow. In other countries, when a VC or PE market develops, then what ends up happening is one VC fund can sell a portfolio company to another VC fund. So they do not necessarily have to go to an IPO to exit. This won't happen if you don't have enough VC funds, right? So it is possible if many VC funds are set up and they are not able to find good investments, they may actually buy from other VC funds. And this could be something that explains why there are actually fewer IPOs in the future, because that is not the only good exit. Now, because I think she has the data of all the investments, maybe she can track whether there is fund-to-fund sales because of this.
Rick, we have a minute.
Okay. So my second comment is the paper mostly looks at counts as outcomes. Number of VC funds going up, number of limited partners going up, and so on and so forth. Now, there's a recent paper which does a survey. This is an NBR working paper by Colonelli, Li, and Liu, which surveys general partners in China and says, do you like being involved with the government? And broadly, they say no on balance, but the main advantage is that they say they will likely obtain support from the local government. And main disadvantage is the government will poke its nose and in the investment decisions, right? Now, if this was the case and I was a fund and I'm kind of extrapolating, I want to be seen as supporting the government, but I don't want to put too much money in it, right? So this would effectively, in my mind, imply that we should see more people getting involved, but On the other hand, they would actually put less money because they don't want to lose money. On the other hand, they want to show that we are supporting the government, right? So if we only look at the number without looking at the amounts of how much money is being put in, perhaps we will see, oh, everything is improving, but what might be happening is actually the amounts are going down. So I would encourage her to look at the amounts, which presumably actually she has access to. My final comment, and this is very quick, what else could be happening? So the main idea is the government focuses on a certain region and pushes things there. Now, there is a very recent working paper, Wang and Yang, which thinks about the political economy of all of these experiments that the Chinese government does. And one of the things that comes out as a main sort of finding is local promotion-driven politicians tend to allocate more resources so that the central government policy experiment is a success, right? That is in the nature of their, I mean, that's the incentive they have. They'll get promoted and so on and so forth. So what I was somewhat worried about is it possible that when the government is actually, central government is trying to push VCs in a particular region, the local government now has the incentives to do other things to support VCs and, in fact, maybe give contracts to VC-supported companies, give them subsidies, and so on and so forth. In fact, she finds that the local government LPs tend to start investing more when the central government LP comes in, which viewed from a certain lens, could be seen as supportive of this. Because in some sense, if the central government is already putting in money, why does the local government also need to do it? They could use the money for something else. But what they are actually doing is they are putting in more money when the central government is putting in money to support the VCs, right? So my suggestion is try to think about this a little bit more, look at government supplier contract data, which in China usually is available. And the final thing is there were other programs in the InnoFund program. She's looking at the InnoFund VC program. There was a program which gives subsidies to small and innovative firms. And if that was also staggered in the same way, you are promoting VCs in a region, you're also promoting small and innovative firms in that region by giving them subsidies and some startup funds, then you might expect that to have an effect on private VC investments. They might invest in those same firms, right? And this data is definitely available because there are papers that use it as to what is going on with the InnoFund program, which is not the VC program, but the ones that affects the firms themselves, right? So to conclude, I think the paper actually uncovers very interesting patterns. Even notwithstanding whatever I said, I think it is still a very significant contribution. A lot of these patterns are not obvious, and ex ante, I wouldn't have expected this. The implications Celine wants to draw, they could be strengthened by doing some more work. But I do recommend, even as the paper currently stands, it's very nice. I recommend people should read this paper. Thank you.
Should I respond or I collect more questions?
Celine, if it's okay, can we take questions from the floor? We've got 3 minutes for the session.
Yeah. But I do want to thank for the very great discussion, and probably could talk a bit more later.
Sure. Venki, your question, please.
Thank you. A great paper and lovely discussion, Rick. Actually, in India, the problem is it's actually reverse. You know, the governments are quite concerned that nobody's following them. The private guys don't come to where the governments step in as far as innovation is concerned. I had two questions. One is, why does the region matter in innovation? In the sense that, is that they only promote locally, either the entrepreneur should come from the region or the company should service only that region? I mean, for example, in India, there are several startups which are officially based in Bihar, the non-traditional states, but they all have offices in Bangalore. They operate out of Bangalore even though their corporate offices are in some other state. So how does region matter in your setup in China? And the other thing is just following up on Rick's point, I think the introduction of a government fund, which usually is a deeper fund, means that it gives some opportunities for private guys to invest in companies which they can later on sell it to the government fund. So it's a lot of a government fund is like a fund of funds at the back end. So it's almost like an option, they're giving a free option for these guys to take the risk, and then if they can just bail out by selling it to these guys and things don't go well. So it's almost like exploiting that option value there. So maybe that is something that you should also look at. Thank you.
Okay, Celine, do you want to respond to people, unless there's someone from the...
Yeah, I could first quickly respond to the first on the why the region matters. The main reason is like for identification purpose. Because what I kind of have for identification is this Stargate introduced program in different regions. But I agree with you that some companies, they might have offices at different places. So one thing I does check is usually the distance is not that large. They might have offices or moves, but still within a closed circle of the focal company, the information I have. So in this sense, maybe my finding is not that precise. It's a bit noisy, but at least the direction should be correct. And then, yeah, thanks for this fund selling to fund suggestion. So yes, in principle, I could clean up that part of data. And it's very nice to have all these comments, because the way I could use the government administration data is there, but I need to clean it. So it's great to see what are most interesting part to clean out. From my anecdotal part, what we saw is it's true that the government funds might, especially the central ones, they might sell transfer the shares to others, but usually it's still transferred to some like local government fund. So in this sense, it looks like the government is not going to exit eventually, unless it's going to be acquired or go to IPO. But yeah, I agree. I definitely could try to clean up that part of data to be more empirically rigorous to see what's really happening. And yeah, for other comments, I think it's all very well taken. And again, it's more like to give me some feedback so I could try to see how to combine other data sets in and what's the directions to work on.
Awesome. So I think this needs a round of applause too, because it was a really nice paper. Thanks a lot, Celine, and hopefully there's going to be an updated version and we can have you in Bombay for the next conference. So the next paper that we have is